I guess they must have this.
They do.
Yeah, people. Well, our names are here,
There.
but not our affiliations.
So we're live. Is everybody going to stand up and speak from the podium?
Yes,
Please.
yeah.
Otherwise, I won't know what I'm supposed to say.
If you'd like to start. Sure. Okay, welcome back, everyone. Hopefully you had a nice lunch and you're enjoying yourself in Washington if you're not from here. And if you are, it's nice to be able to get out of your house, I guess. So we're the next panel at 2 o'clock. It's panel number 3, Financing of Technology Transfer. So while people come in, I think we're just going to start with just some introductions and just a couple of slides on what we think the panel is about. And then the panelists will get into more depth. On the panel, I'm Tony Stanko. I'm the moderator, and I'll have a few slides. Then we have Michael Anton, Lita Nelson, Dietmar Harhoff, and Kesh Karayanan. If I got that right. Kesh? Yeah. How'd I do? Thank you. All right. This kind of builds from what we talked about this morning on commercializing technology transfer and how this new innovation economy, knowledge-based economy, really is going to manifest. Our part, for the most part, will probably talk about startups as a way to do the tech transfer. I have a couple of slides here. Well, let me give you I think everybody's going to give a small introduction of themselves, so let me say a few words about myself just so you have a little context. I'm with George Washington University. I'm the director of the Council of Entrepreneurial Tech Transfer and Commercialization on the School of Engineering side. I'm also the director of the National Council of Tech Transfer, and I used to work at the Securities and Exchange Commission as a securities attorney, and I worked on a few hundred IPOs. At the time, in the late 90s, there was also a move to look at innovation economy issues and how tech transfer, university, angels, and VCs fit into the picture, and so I have a little bit of experience there. Here's the website for the National Council. We're going to do a couple of events. If you want to take that down, you're welcome to come. We could actually be interested in a German perspective or an international perspective. We tried to do it last year. We had Canada. If we could find the space, it'd be nice to have some.
What about next year?
Next year, meaning October 3 to 5/07. That's what I mean by next year. Sorry. Okay. What I'm going to talk about is basically the traditional VC model. The slides that will be included in whatever package is being handed out will have something a little more elaborate. It will talk about using tech transfer startups as outsourced R&D for large companies as part of the open innovation paradigm some people are talking about. But I won't get into that because I only have a few minutes. What I'm going to talk about is more the traditional VC model, which I think is where most of the world is and most of the U.S. is. That's basically taking federal money, having that invested either at a university, so they do R&D, or a federal lab. I include both in here. And then that gets commercialized. Well, actually, there's three ways. The most traditional way is that you used to graduate students. They would take the technology and they would go work somewhere, and that's how you would commercialize whatever they learned. Well, let's avoid that one for a minute and talk about traditional licensing to large companies, which is probably the most technical definition of what people think of when they think of tech transfer. It's licensing. It isn't tech transfer through startups. That's a new twist. It used to be, and for most people I think still is, licensing, which is a very different thing. I mean, you can't really compare the two, so you have to keep those in separate boxes. Otherwise, you'll get confused very quickly. What we're going to talk about in this panel is really tech transfer through startups and through other relationships with Michael. Michael has a bit of a spin on that, but we're talking about tech transfer through startups as the vehicle, and that is how we see financing of tech transfer. Well, traditional tech transfer has its own problems, which is how do you find the large company to take your innovation or your R&D and commercialize it? I mean, it seems simple enough, but it's actually pretty hard. They have their own product cycles. They have their own markets. They used to have NIH, not invented here syndrome. So it's pretty hard to actually make that connection. It sounds simple, but it's actually very hard. So a lot of people seeing that there might be a different way, try to do it through startups. Because startups, what's the benefit of a startup? Well, startup that's created to commercialize the R&D doesn't have that matching problem. It's set up to commercialize it. But then you solve one problem and you create others. The first problem you create when you try to do it through startups is, well, who's going to run the startup? Who's the entrepreneur? Until you solve that problem, you go nowhere. It's basically a bus without a driver until you find that entrepreneur. So let's assume you do that. That's not a trivial problem. That's probably the hardest problem. People think it's the money, but it's actually the entrepreneur. Finding the entrepreneur, the good entrepreneur that can get the money, is the hardest problem. But let's assume that problem away too. The next problem is, so now you have a startup, you have an entrepreneur, maybe a startup team. Where's the money? These people generally are ex-employees, right, or wannabe employees if they were grad students. They have opportunity costs. They don't have money. So how do you finance them? Well, the solutions here have been angel round financing. There's a lot of myths around. People think it's VCs that fund these things. Generally, it's not VCs. VCs come in after a couple of rounds of angel money. And I'll just lay this out and then kind of sit down. But angel money is really the money, the first money in that will take it from a lab to a startup and commercialize and maybe prove out that the R&D has something, can go somewhere. So you have commercialization funds that run, to about $500,000, $500,000. If you reach that part, and you can do that sometimes without angel money, but most times you need angel money to fund the people that are running the company, you then have to get to the next stage. The next milestone really is productizing, finding some beta customers. So you take it from the lab, prove out the technology, it works. Now you have to create a product that people will buy. Sometimes it's shrinking the products, getting rid of the soldering and the wires and, those kind of things. And then finding the beta customers. That's the key part. Once you do that, now you really have a company. But that generally takes, a couple of $1 million to get there. If it's 3 or 4 people, PhDs, opportunity cost of, $100,000 each for a couple of years, you get to $1 million pretty quickly. Once you get past that part, that's where the VCs come in. They used to do the angel part 20 years ago, 30 years ago, but they certainly don't do it now. And the angel rounds come in not to do the early commercialization, not to test the R&D or the technology, not to find the first few customers or find the market. It's to scale. It's to scale the product, scale the manufacturing, get the marketing in place, and get the distribution. That is not trivial. Actually, that's where most of the money goes to. It's not creating the product and getting the first few customers. It's getting the first 100,000 customers or the first, $10 million worth of sales. It's easy to get $500,000 worth of sales or $1 million worth of sales, but getting to 10 or 20 or $100 million is serious distribution and marketing issues. After you do that, if the VCs come in, and they come in between 3 to 5 for the first round, they test it out, then 5 to 10, then 10 to 50, they need to exit. Because without an exit, nobody makes any money in the process. And it's almost like wholesaling. Everybody's a wholesaler until the end. The retailers are either the IPO markets or the M&A markets, the mergers and acquisitions. They're actually the buyers. If you think about it in terms of shoes, they're the shoe store at the mall where people actually take the shoes to wear. They're the ones using the technologies at the end, in a sense. Everybody else is a wholesaler, meaning that they're buying to resell it to somebody else. So if you understand that and you look at it from the end point, you understand if the IPO market isn't active, you can have the best technology, you can have the best company, you can have everything perfectly lined up, but nobody's going to buy it. And that's what happened after 2000, 2001. The IPO market closed, so the VC said, hey, we got enough stock on our shelves, we don't need any more. Recently, that's still pretty closed. It's almost starting to open, but it's still pretty closed. Recently, the exits have been M&As, mergers and acquisitions, which are basically a substitute for reaching the financial markets, because those M&As, for the most part, are large companies that have already listed on the stock market. So at the end, the exit is to a stock market, either in an initial public offering or as part of somebody else's company that's already on the stock market. So with that, I'm going to kind of pass it on to Michael, who's going to take a little bit of a different look at this, and then the rest of the panelists will really kind of feed into the model I laid out. Should I find it for you? Okay. I guess it's this one, right?
No, that's
This one?
this one, the first slide.
First one. Okay. No?
No, this one. But we have to.
Oh, we have to go to the first slide. Okay. And slideshow. There you go.
Yes, good afternoon, everybody. I'm, as Tony said, taking a little bit of a different angle. I want to talk about the process of having Atlantic knowledge and technology transfer. But before I'm getting to that, even though that Garrett has already introduced a little bit of the state of health very briefly. Where do I get down here? Yes. I am from Wiesbaden. Wiesbaden is 25 miles from Frankfurt. It's much smaller than Frankfurt, and suffice it to say, it's much more endearing. So you're most welcome when you're over there. The University of Wiesbaden has about 8,600 students and about 260 academic staffs. We have 37 study programs, 25 undergraduate and 12 postgraduate. I want to start out with transfer successes. Transfer success not meant here as having made lots of money with industry, but transfer over the Atlantic, going arm in arm between Wiesbaden and, in the first example, laboratory automation. We are close to Washington at Gaithersburg with NIST. Another example is wood concrete composite structures, where we have partners also here in the United States, the University of Massachusetts and the University of British Columbia in Canada. We have in microelectromechanical systems contacts and in hydrogen technologies, that is especially in fuel cells. These cooperations between these different places in the United States and Germany are long-standing. How are we getting to transfer products? That's a brilliant idea. We have an emerging innovation. We push it into the international market, and all we have to do is financing of marketing activities. And that's what we would like to have. But it would also not be really in the best interest of the university of just doing marketing. Fortunately or unfortunately, the world is not that easy. Ideas, if they are brilliant or not, are born usually in communication with different partners. From ideas spring emerging innovations. Emerging innovations, you have to work them out, you have ripening technology, and yeah, you hope so. At some point in time, you will be ready to market. The angle I want to be putting on here on the transatlantic aspect is that even ideas are usually generated through network contacts, cooperation, ideas to flesh them out, getting them to the state of emerging innovation. You are not networking, you are cooperating, you are further detailing them over networking cooperation until you are close to market. You have always different partners on board. And the financing requirements, even if you are in a national situation, it costs money. But in an international or even transatlantic, you have all these additional costs which go far beyond everyday communication. You have to get visiting one party or the other, and to move things together along. Now, I wanted to make here already the remark that networking is not only between research institutions. We are in applied science, and very early on, you have to include industry in one type or another. In this scheme, we have to realize first that we have several years from inception of an idea to market. In this process, you have changing work foci, fields of activity, and lines of action. All this puts changing demands on and suitability of network partners. And here I want to extend on the involvement also of companies. In a transatlantic setting, in the examples I have shown earlier on, we do have industry partners, and these are by definition in this field internationals. In laboratory automation, for example, it's Hewlett-Packard and Agilent Technologies, and both sides of the Atlantic work with different with their respective branches in the United States and or Germany or Europe. From the changing demands on and suitability of network partners, over the long process of getting from an idea to some kind of a product, you have to keep the composition of the network flexible. This flexibility means that you cannot lock in the network in a wired network. And to get financing really realized, you have to have each network hub to finance its activities. That's the major point I want to bring across. And I'm a little bit of a heretic here. Current tendencies are you have an idea, you have to set up a group, a agglomeration of participants who go through all the process. This locking in, you cannot not get a project definition from the start out that lasts for several years. Some caveats. In this setting, intellectual property rights, what's with that? And who gets the spoils? It is such that in a flexible setting with networks, you cannot from the outset have everything nailed down. To speak for this model of flexible networks, brilliant ideas are protected immediately. You can take out patents very readily, and you can sell or license them. Evolving ideas and innovations, which take time, you have to trust that on the way you have spin-offs at each step, and you also have to to demand on the network partners not to realize and to flesh out one idea, but on each step on the way to go into different type of spin-off ideas and work on from that, so they have not lost anything in this flexible model. Scientific advantages at each step, and you have economic gains at each step on both sides of the Atlantic. So, thank you.
Thank you, Ray. Thank you, Michael. And now we'll have Lita.
I'm going to take a somewhat different tack. I'm head of MIT's Technology Licensing Office, and we've been involved with startups now for 19 years, I guess, and are seeing some fairly recent trends in the last 5 years that have caused a fair amount of problems. And I'm sure you all have them. I'm going to describe some of that, of where we see funding coming from for our startup companies. And then I'm going to use the last few minutes to talk about the Deshpande Center, which is not the solution to the problem. It's one piece of the solution to the problem that may help provide a model. That's assuming I can find it. There it is. Okay, here we go. Terrific. Okay, we all know this. University startups are high risk. That's their problem. We're not talking about .com. We're talking about stuff that's where the commercial fees and technical and manufacturability are unproven, where the classic venture capitalist or strategic planner estimate of time to market has probably a factor of 3 mistake. The market acceptance is probably difficult to estimate within a factor of 10. And the more innovative it is, the worse the estimates are. And we've all heard the stories of how many Xerox machines would you possibly need and how many computers could you possibly need. They were only off by a factor of 1,000 probably. And you seldom have a management team. So if the investors say, the 3 things we look at first is management, 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 well, we don't have that. In fact, when we first started doing business, we thought we had 0-stage deals, and we were told, no, you don't. A 0-stage deal is a technology business plan, a management team looking for money. What you guys have is -2. But what that means is that we're looking for more than just money. We're looking for a synthesizer with experience and access to capital. So who funds the startups? Well, there's a variety, and you've all heard the words. You can fund yourself with friends and family. You can fund yourself by corporate alliances, perhaps. Maybe bootstrapping, that is, you start with 3 people and they do consulting, and then they eventually get to sell something. The angel investors, the venture investors. In the U.S., these SBIR and other government research grants Some of you from Germany may be surprised to know that there is no federal funding for technology transfer per se. Nothing to support patenting, nothing to support tech transfer offices. There's a little bit occasionally from some of the states, but on the whole, the universities are bootstrapping themselves. And then we'll talk about university funds. Now, it's usually a combination of these things, as Tony started to refer to. But I think it's very important, once again, to divide things into technology sectors. Yeah, you might be able to get a software company to profitability with bootstrapping and a little money from your Uncle Ben. And you might be able to get a relatively simple instruments, can find some angel investment sufficient to reach market. Or might even be able to do it on SBIR grants. Some medical instruments might reach the stage, probably not of profitability, but where they can sell themselves off to a big company. But when you get into the technologies that are going to change the world, new biotechnology mechanisms such as short interfering RNA or new materials like superconductors, you're going to need venture funding in later rounds. When you start with the angels, I think one of the things we've learned is that there's a hierarchy of angels. There used to be, I decided to leave off all the seraphim and cherubim and archangels, but probably the worst kind of angel is what we used to call doctor and dentist money, people with too much money who were tired of investing in real estate and wanted to get into high tech. And the problem was that all they had was money. And they weren't prepared for the problems involved in getting really new technology off the ground. So the next level can be very useful. That is, the people who made their money by having a successful company themselves in the field in which they're now supporting new companies. And they can be very, very useful indeed because they have access to capital, they have access to strategic alliances, they're useful on the board of directors, and this is critical. Even better are what we call the shirt-sleeved angels, where you roll up your sleeves and actually not only put your money into it, but get help actually become part of the company. Maybe just a very active director or advisor, or maybe even help run the company in its early stage. A new trend we're seeing is angel networks, which is organized clubs of angel investors, usually in a local region. They do it so they can access more potential deals. And potentially they have, if they've got 24 people, they've got somebody who understands medical devices and somebody who understands computers and somebody who understands whatever. It also allows them to pool small investments. That is, maybe 10 of the 30 people will decide to each put in $25,000, and then you've got enough to get something going. We thought this was a very helpful trend, and maybe it is, but what we found is that they tend to be extremely conservative. They can sort of unthink any deal and what's wrong with it. We find that the individual investors are far better. One of the bad things that happened, and this has really been a long hangover from the dot-com, dot-bomb area, was that nowadays angel investors have become very wary of investing in companies in the early rounds that will later require larger rounds of funding from real venture capitalists. And that's because during the dot-com era, and then when all those dot-com companies all needed money at once, the Olympic sport of cram down, where basically it came about, where basically the venture capitalists coming in to save the companies put in preferences and dilution and whatever that essentially wiped out the investment of the early stage investors, the angel investors. So the angel investors are saying, if we go to venture guys and they're going to kill us, we're not going to fund anything that's going to require later venture funding. So that has sort of, in some ways, the venture capitalists are poisoning their own seed corn because the chain of value that Tony talked about has been poisoned. In the venture capitalist funds following dot bomb and, of course, 9/11, first of all, even through 2006, they had not recovered from the dot-com era, and I guess that the severity of the hangover is proportional to the degree of inebriation. So it was pretty bad. So they became reluctant to invest in early-stage technology. The other thing that happened is the little funds that had all formed during the dot-com era disappeared, and the older funds were left, and they started raising more and more money, so that instead of having $200 million in their fund, they have $800 million or $1 billion. That makes it very hard for them to put in the time, the partner time, to study a new opportunity and maybe place $5 million. It's just not worth it to them. You can't place $1 billion, $5 million at the time. So once again, reluctant to invest in early stage technology. They're also looking for shorter term liquidity. That is something that will go from investment to getting your money back in 3 years. They got spoiled by .com and they don't realize they're not going to be able to do it again. And of course, although there are some IPOs, they're fairly tightly closed. We are now finding the venture capital pendulum beginning to swing back to early stage investing. I can tell by how many phone calls I get saying, we'd like to come see you and see what you got. Mergers and acquisitions have been replacing IPOs in liquidity routes. And another thing that's happening in biopharm is that if you've got a molecule that's starting to look good, even preclinical, you can now sell it off sometimes to big pharma for 200 or 300 million as opposed to 10 or 20 million. The venture funds have discovered a new paradigm. Actually, it's a very old paradigm, that instead of chunking in 30 or 40 million dollars at the beginning and telling people to run fast, invest in smaller amounts with milestones. But it's still hard to find investment for early stage. Some of the universities have looked at their own funds potentially as bridging the gap with resources to bring early stage inventions to fundability. Fundability means somebody outside the university, and in the US it's not government, to put the money in. That is, bring it further along. And there are a bunch of different models: incubators, philanthropic funds, grants from universities, and even venture funds. The problem with the venture funds is they're often unclear whether they're primarily there for local economic development or to bring technologies to market or for return on investment. And when you ask the heads of the funds, you get, we're not sure. Well, it's really there to help the economy, but our incentive system is all about ROI. So you get a lot of mixed messages that to date, there have been few, if any, successful financial models from university putting their own money into these things. Now, whether it will develop, we don't know. I'll tell you about one of our experiments, which is not a financial model, and that was Desh Deshpande, founder of Sycamore, funded a $20 million philanthropic donation, and the fund is now building, the center is now trying to build a further endowment. And by an endowment is what we're saying is we're not trying to pay ourselves back. We're trying to fund projects based just on the interest so that it becomes evergreen simply because it's an endowment rather than expects a return. The way it works is it gives competitive grants for academic research. This is not development, but it's academic research a little further along, or with to help a bright new idea show if it might work, something that has a reasonable probability of forming a spin-out. It's academic. There are grad students and postdocs and no confidentiality, academic rules on publication, and if the company is already formed around the invention, it's not eligible for a grant. So that's the rules. But the most important part of it is how it gets the business and investment community involved in the process. First of all, in project selection, we have volunteers from the business and venture capital community to advise on the proposals and the project selection. Then once a project is funded, each project is matched with a volunteer catalyst, who again is a volunteer from the business or investment community. And they act as mentors to the project and to the principal investigator. They are not the people who are going to fund this someday, or at least they're not supposed to be. They're people who just act as advisors. Our business school students form innovation teams whose job for each project is to study the market and potential applications, and perhaps a strategy for the platform technology. And then there's a lot of parties, networking sessions with business and investment community, serve them wine and sushi, and have poster sessions around and have them talking to the principal investigators. We also have a venture mentoring service, which is not part of the Deshpande Center, but again, volunteers from the business community who mentor Deshpande Center projects, but also any other potential startups from the MIT community on business strategy, business plans, and fundraising. So our belief is that the way to get technology moving is to establish continuing connections with the business and investment community. The cliche in the university tech transfer community is that tech transfer is a contact sport. Thank you.
Thank you very much, Lita. And now we'll have Dietmar.
I'll do it. This one? No.
Yeah.
Never mind. This one. I have it. Ladies and gentlemen, thanks for having me on this panel. And of course, it's very difficult to top a presentation by Lita, coming directly after her as a presenter. And she named quite a number of issues already, which even in an economy which isn't quite as developed as a venture capital market are present. The acrimonious relationships between angels and VCs, the fact that there is a dearth of early stage finance out there, and many other problems. We will encounter them in the next few minutes again. But before I do that, following the example of my other German colleagues, I will also give a dog and pony show of where I'm coming from, of course. I'm coming from LMU. LMU is, we claim, one of the leading research universities in Europe. It's old. I don't have to give you a map for you to find Munich. You know that's where the beer is and where the Oktoberfest is and so forth. LMU is a fairly broadly diversified university with 18 faculties, slightly bigger than the Free University of Berlin. Fortunately, we also have a few professors more, but we share the same problem, which is that the relationship, the number, the ratio of professors to students is far, far lower than at any of the research universities in the United States, including the public universities, by the way. We're quite proud that there's quite a bit of research going on. We're quite proud that there are Nobel laureates at our university and that we regularly get the largest share of DFG money in the Federal Republic. Let me highlight a few critical issues. We're talking here about turning research, academic research, into economic results. And this is what gets the policymakers really interested, because this is all about jobs, this is about wealth, this is about productivity. Otherwise, they wouldn't care. Okay? If it were just research for its aesthetic purpose, they wouldn't care, I bet you. So what are the critical issues? First of all, I think what you ultimately need in order to make this model really work is an entrepreneurial culture at universities. And that's not easy if it hasn't been there before. Okay? So we need to think about that. There is an issue of science versus action, ivory tower versus dealer-wheeler, papers versus projects. Okay? There are colleagues that I have in engineering, for example, who do not write a lot of papers, but they do a lot of projects and do a lot of good getting technology out of the door. There was a recent assessment, by the way. Let me give you this little example. It's funny. The UK and the German research councils, research support organizations got together and did a little evaluation of mechanical engineering in Britain and mechanical engineering in Germany. And you know what they found? They found that the Brits wrote papers and the Germans built machines. Okay? By any indicator measuring productivity in scientific publications, the German departments were far worse off than the Brits. by any indication of economic impact on the machine tool industry, the Germans were better. There is a real conflict here. And we need to resolve that discipline by discipline, because the trade-off is different in biotechnology than it is for mechanical engineering. And that's one of the very difficult tasks that university leadership has to resolve nowadays. Okay, there's resolution of IP issues. You were told already that the game has changed in Germany. By the way, almost in the same month when Germany went to a system where the IP is now in the hand of the university, Italy went the other way and went to the German system that we had before. But there is a problem here, and the problem goes further than just handling IP. It's norm conflicts, it's rules of the game in the academic business, and this is all very difficult. There's the business of efficient management of IP, which is new to German universities, but has to be resolved. There are ownership transfer issues if you want to make startups successful, okay? Then there's the problem of something like incubation, and I call it seed squared. It's early. It's the -2, phase -2 that Lita referred to. And of course, there are various sources there, but these sources have not been common sources of entrepreneurial finance in Germany. I'll get to that a little bit later. Finally, there needs to be a link to experienced entrepreneurs and managers. And I'll come back to that issue because alumni networks are very important here. We have not been great in Germany in building alumni networks. We haven't even been great telling people at which university we got our diploma. Why? Because we didn't care, because the universities didn't compete. Now they compete. We now have a different game, and a lot is changing in this game. And of course, there's the issue of startup finance. Now, a little bit of data here, okay? If you take German universities and other publicly financed research organizations like Helmholtz, Fraunhofer, and Max Planck together, then in 2005 they accounted for roughly 4% of all patent filings. That is relatively low, okay, by European standards and also by US standards. Licensing revenues, I'm giving you the numbers here, you can read them up when you go to the slides on the website, are relatively low by US standards, okay? But nonetheless, let me give you the MIT figure. Lita, you will check that, okay? You'll keep me honest here. Budget of about 2 billion licensing, 38.3 in 2004, is that right?
Not for MIT.
Bottom line.
Not for MIT. Oh, the budget. No, budget's
Budget is
about $1.25 billion and licensing about that, yes.
Okay, good. So we got at least the licensing figure for
That's
which you
MIT
sign
plus
responsibility.
Lincoln Land,
Yes,
about
yeah,
half,
yeah,
yeah.
okay. Well, please take into account when you take the budgets of the German institutions or German universities, if they have a clinic like the Charité or something like that, that budget is typically in the numbers, and that's usually a huge part of it, okay? Okay, we're not good in Germany turning patents into startups. This is from a survey that a few European institutes did together. It shows you the share of patents used to start a venture in different countries. Okay, you see Hungary, the UK, Spain, Denmark, relatively high. France, Germany, continental European countries, not good. Well, in Germany you could say, hey, we have a lot of patents. Okay, so but even if you figure in a factor of 2, which roughly compensates for the not so expressed tendency of our British friends to file patents, we're still below that. What about the VC industry? Okay, many of you do know the story. Germany is a latecomer into the VC industry. There were attempts to establish something like that industry in the early 80s. They failed. It's a small and immature industry right now. 1/3 of the funds have less than 20 million under management. Only 1/3 have more than 100 million euros. The IRRs, internal rates of revenue, for those who come from the United States and want to invest money look relatively low, and people invest rather in buyout. Because you can make huge returns right now on restructuring small and medium-sized German enterprises. Let's call it medium-sized enterprises because they're typically on the order of between 50 and 300 million revenue. So the German Mittelstand, okay, is in a financing crisis to some extent right now. And that is being resolved with private equity, sometimes fueled with hedge funds, by hedge funds, okay? So the money is going there. It's not going into growth companies. And that's a problem. We have an unfriendly tax regimes. We constantly have to tell our tax folks that the game is not to punish people, because if you try to punish them, you chase them out of the country. But the only game that works with the tax system is to reward them somehow. But they don't fully understand that. Well, maybe there's hope. There are refined models of public support out there right now. The High-Tech Gründerfonds was already named. It seems to be running quite smoothly, but the levels of funding are quite low. And what you find in Germany is, if you look at the typical venture capital investment round, it's by a factor of 4 smaller than in the United States. If you look at biotechs and compare them to the UK, it's by a factor 2 smaller. Okay, let's not look at R&D because I'm running out of time. Is there light at the end of the tunnel? I think there is more attention for entrepreneurship than we ever had before. So I'm not sharing the somewhat or the extremely pessimistic views of my German colleagues that I've heard before. I'll go into that in a little while. There's greater acceptance for entrepreneurs in academia. Now, it's not perfect, no. But if you go to MIT, it's not perfect there either. There are some people who want to do their science, and we should not prevent them from doing that because we would be killing the goose that is laying the golden eggs, after all. Okay, universities are there to do science. Technology transfer is another issue, and it's important, but it should not substitute for the other purpose that we have. There's more competition among universities. There's more degrees of freedom. We could improve degrees of freedom a little bit. There are fewer fairy tales. At the beginning of this, many chancellors believed that this was the way out of their financial crisis, that they could generate so much money out of technology transfer that it would substitute, for example, for the tuitions that we just introduced. There's actually an article in a well-known weekly, Die Zeit, I think 4 years ago, where somebody claimed that we don't need tuition, we can substitute everything with licensing and stuff like that. It's otherworldly. However, there are also fewer fairy tales, and let me criticize a little bit the stories that I've heard so far. I'm hearing this story about expressed risk aversion of Germans so often. I'm really getting tired of it. The statistical evidence for that is so slim. We should not reiterate that. Okay. Same for penalties for entrepreneurship. I don't think that is the case, really. Okay, what are the solutions or the potential solutions that we tinker with in Germany right now for this seed squared, the early finance problem? Okay, first of all, you need case-specific solutions, maybe solutions that are university-specific and even then technology-specific. Typically, there are very small amounts needed at that stage. Okay, this is not. I wouldn't say 500,000. I would say it's even lower by a factor of 10 in the German case right now.
Depends on the field.
Depends on the field, yes. And that's too small for VCs, clearly too small for VCs. And it's also, in a sense, for many universities, too large, because you would need 30, 40 projects in order to make that self-financing in the long run. There's a tyranny of numbers here. Okay, if you don't have that many projects, you have to find a centralized solution, pool that, maybe with the technology transfer at the state level. What are possible solutions that have been tried out and that appear to be working? There are transition models in Bavaria, a project that called Flügge, which people at our technology transfer office have been using. Christoph Zinser is here, have been using with great success. That model lets money from the state come in order to allow postdocs, who are most often the carriers of technology, stay in university employment for another 6-9 months while they are working on the startup. It allows them to use the equipment of the university during that time period to push the startup forward, but there's relatively little risk for them. Okay, so it's a transition model. There are transition models now at the federal level. Let me explain this ExistGo Bio to you. The ExistGo Bio is based on the observation that in science we have models where young scientists can get funding for junior research groups. But these are going into the scientific direction. ExistGo Bio allows them to go into a commercialization direction, and it even requires that they hire somebody with business experience and business knowledge into the team of 4 to 6 people who are bringing the technology forward. Tap into alumni networks, I mentioned that already, both for experience and for money. Build micro labs. I would like to say more about that because this is something we're tinkering with right now. It's a pre-incubator, if you want. And of course, link something to teaching. Lita mentioned already, bring the business students in, let them work for the founders. Okay, it's a great experience for them. It's a great experience for the founders because they get the marketing research for free. And above all, I think it's very important that you build support among key faculty members in the science faculties and otherwise. Don't have to be many, but they have to be the key faculty members Because otherwise, the issue of technology transfer will run into a stone wall. Because after all, it's still a university, and it's good that it's a university that undertakes science. Thank you.
Thank you very much. And now we'll have Kesh.
You got it? It says Kish. Thanks. I'm Kish Narayanan from National Science Foundation, and for those who don't know, National Science Foundation is a federal agency, so I'm here to give you a bureaucratic answer to all this exciting talk you heard. But having said that, it's one of these interesting situations. National Science Foundation is about a $6 billion funding agency, almost completely funding agency. In the world of the federal government, $6 billion is considered pretty small, which I came from an industry and I thought I was surprised. So because of that, I think NSF, National Science Foundation, has considerable freedom to operate, and we'd like to think we are doing something innovative. Let me start off with, this morning you heard from a congressional perspective and the president perspective, this term, American Competitiveness Initiative. So let me start at the top level. This was launched by President Bush last year. You heard about this morning how it's a commitment to double NSF budget, which is really investing in the fundamental science and engineering, in research and education. And probably I want to take two words within the American Competitiveness Initiative, which talks about creation of knowledge and harnessing of knowledge. And that's really what this whole ACI, American Competitiveness Initiative, is about. So with that, the NSF vision lines up with the President's initiative, advancing discovery, innovation, and education beyond the frontiers of knowledge and empowering future generations of science and engineering. I highlighted innovation here. It's part of NSF vision. Having said this, again, as Lita was pointing out, we are very, very much in the investment on discovery, very much in the investment on education. So the question, how does innovation fits in? So if I look at the NSF as it's not to really show you some of the organizational chart, is to, does this work? Yeah, I think. It's just to point out the discovery for innovation, which is what NSF is all about. And that's the primary investment, is the discovery for innovation. In that context, where I sit, let me see if I could just go back. Yeah, where I sit is in the bottom left side, what I like to call it discovery to innovation. And that's the part, is the industrial innovation partnerships. It's a small part of the big NSF. And that's what I want to emphasize in this context on the discovery to innovation. So there are many, many programs within NSF which have innovation through partnerships at NSF. And you can read them, the science technology centers, material centers, the computing centers, engineering research centers. I put in red some of the ones which are part of the division that I manage, and I want to use last few slides just to talk about the small business research program. All of these in red, every one of them has university and industry partnerships. And let me focus just for this discussion on the Small Business Innovation Research Program. Okay, in this YSBIR, or that's the acronym used, if you look at the employment of scientists and engineers in the United States, so if you take the thesis that technological innovation is going to require scientists and engineers behind them, then majority of the scientists and engineers are in the small and medium enterprise. 36%, followed by large business. So a significant portion of scientists and engineers in the United States are employed by small business. And of course, this is the academia, the university, this is the government. So the role the small business in the technological innovation plays is very critical in the United States, and I think we recognize that. So Lita already showed this chart, and I just happened to pull it up from the American University Technology Managers. I think, Lita, you were a chair on that, right?
Long time ago.
Long time ago, yes. And we talked about friends and families, fools and all. This just gives you the percentage for the chart that Lita already had. And SBIR is a component of that. Only point I want to make is SBIR, STTR, this particular one is not only for startup business. It's also for established small businesses. So I just want to make sure I don't confuse you with that. I want to give one example out of the hundreds of small business success stories that we like to talk about. I picked one. This is a Sensen technology. The technology is involved in mammography. There's conventional ultrasonic methods, then there is the X-ray method. Then what the Sensen technology is using is a silicon capacitant approach, which is much more, the sensitivity is much higher than the piezoelectric ultrasonic approach. So it has the friendliness of the ultrasonic approach, and the precision, the sensitivity is now much higher. Then as a result, the reason behind it is it's a MEMS technology. It's using all the silicon-based technology manufacturing. So it has the automatic built-in manufacturing capability for the precision, which translates into the resolution they can get. So that's something. In this story, they had an SBIR award, so the federal funding. They were able to, you heard a lot about angels and ventures. The angels, a group of angels, invested more than $1 million. We, NSF, put 50 cents to a dollar as an incentive for them to go get that. So we funded them beyond the SBIR, what we call it Phase 2B program. And they went on, and in this context, I thought I'll give you a German example. They were acquired by Siemens Medical. So they are, as we speak today, a division of Siemens Medical. They are located in California. This again, in the Tony's example, this is a mergers and acquisition approach. They use the angels, but they didn't necessarily go the IPO route. So with that, again, as I said, the two programs, SBIR, STTR, are the two programs within that we manage. And I want to end with, it's a question of so what? You know, there's an issue of metrics. So this is my last slide where I want to walk you through this. What we did was we had invested in the last, say, 5+ years, about 400 companies. And we first, at the beginning of the award, we called them up. And we said, first we called them up and we found out about 40% were successful in the sense that they generated some money. So 60% for technical or marketing reason did not. So using those 40%, at the beginning of the award, they had about revenue of about, let's say, $300 million and employed about 3,000 people. So it's on our average, the average number of employment in the 10 to 20, revenue in the $1 to $2 million. Then at the time of the survey, which is about roughly 5 years from the beginning of the award. So this is from here to here is 5 years. They doubled in revenue, then about almost 50% increase in job. So the job creation and the wealth creation, that's really what this is all about. This is an average number of about 150 companies, successful companies. And that's really, I think, is the ultimate metrics for a successful technological innovation program, especially in the public-private partnership. Thank you very much.
Kash, thank you so much for that. Okay, we're going to open it up for questions, and I guess we have almost just over half an hour. Kash, I want to ask you something, though, about, or at least highlight something about your example with Sensent.
Sensent.
Sensent?
Sensent, yeah.
I'm just going to bring it up. I didn't talk about it in my presentation, but the slides, if you look at them, talk about open innovation. And this is actually an example of that, because you didn't use any VCs, or they didn't use any
They
VCs.
didn't use, yeah, that's right.
So it's actually a very interesting model to use.
And the technology came from a university. I
It
didn't
did.
talk about
Okay,
that.
well, that's even better. That's a really good example of that whole idea, because most times VCs are not going to be able to invest in these companies. It's just it's a numbers game, and most of these companies will never produce the returns that a VC needs to use their funds, use their time. But if you look at this example, it shows you another model, especially for Germany and countries like Germany, where you don't have a strong VC market and you don't have a very strong IPO market. Here's a company that came out of a university. I didn't know that, but it got some government money, but mostly angel money. Angels, $1 million, that's almost nothing. What did they really end up doing here? They created, for Siemens, their R&D. It's an outsourced R&D program for Siemens. All of these large companies have that particular problem, in the sense that they have lots of money. That's not the problem. The problem is they can never fill their R&D pipeline with products they can sell, because there's a lot of reasons, and a lot of them have to do with incentives. But for them to take their money and then buy the winners on the small business side is just a winner for them. It's just, it makes so much sense. Any idea how much they ended up paying?
They won't tell us.
Yeah, but if you look at it, I mean, you got to look at it this way, right?
It was big.
It was big,
It was worthwhile.
but all they really needed to do was 10 times. And they ended up doing, I'm sure, more than 10 times. But to make that system work, they just had to sell for $10 million. $10 million is, VCs don't even start at that. So that's why it will never work if you have a VC component. And for a company, $10 million and up, it was probably 50 or 75, my guess. But for a company, $10 million to do their R&D is peanuts. It's cheap. Usually they'll spend $50 to $100 million on these kind of companies. So there is this huge benefit for everybody, but you have to kind of see it as an open innovation play, as an outsourced R&D play, because the company would not have taken the technology out of the university. It just was probably too raw.
It was too early, yeah.
Yeah, and they didn't have the mechanism to take it to the level where they could have made a product out of it, which is why that tech transfer startup group that did it. It'll work. It'll work in any country, basically. It'll actually probably work better in your countries than in the United States, for the simple reason that a lot of people that do this kind of thing here want $1 billion. They don't want $50 million. They want an IPO. So I just wanted to highlight that. That was very interesting. But let's open it up now.
Yali Friedman now. Yali Friedman, New Economy Strategies. So I wanted to actually ask a somewhat controversial question about there's two sides to this timeline. You can help push technologies along the way by funding technology transfer at the early end, or you can also pull technologies at the other end by making sure that there's strong exit opportunities. And so if you take a look at a lot of the American successes, the start of new industries, the IT industry, the biotech industry, those things really got off the ground before a lot of the supportive legislation.
But there was no.
Before what?
A lot of the supportive legislation before STIR, before BAYO, before a lot of that. And so the question is, I mean, America right now, the stage America is at, is such that you need a lot of that supportive stuff to keep the engine running. But in Germany, is it best to be following today's American models or yesterday's American models? And given that American companies are increasingly looking to list on German stock exchanges or do reverse IPO to avoid Sarbanes-Oxley, are there any efforts being put into increasing liquidity and opportunities on the German stock markets?
Well, maybe I can say a little bit about that. Most economic observers consider it a detriment, a disadvantage, that the exit opportunities in Europe are scarce or problematic. And somehow German startups at least have not, to the same extent as, for example, Israeli startups, found their way to US stock markets. So that is a real problem that tilts the balance of exits very strongly towards mergers and acquisitions, not just in Germany, but in continental Europe as a whole. Now, that implies something which is very important. There's a very important question which I think nobody has found a fully convincing answer to. If you look at the growth performance of European startups, you find probably one that had a truly stellar performance. That's SAP. Okay, but there's only one SAP. Whereas in the United States, there have been many companies who have had a similar growth performance over the years. And the answers to that are that the European markets are relatively fragmented, that there are no exit opportunities, or at least not well-developed exit opportunities. IM in London is probably not as suited as an exit opportunity for European startups. So yes, there is a problem. And that has to do with the overall regulatory framework. People are working at that, but it probably takes quite a while to get that going.
Well, one of the points I want to make, though, is that American companies are actually looking to this German stock market.
Yes, but that's, and I consider that a little bit of an anomaly, because regulators in the United States will figure out that Sarbanes-Oxley may have gone a little bit too far in the search for the right level of regulation that you want to have. I mean, you don't want to make it easy for companies to cheat. Their shareholders, but you can do a little bit too much and you can make it bureaucratic, which usually has been the domain in which we have been more successful.
Thank you. I just have a question to Tony. Your VC model for startups, it sounded like you're doing it 5 times a week, very routinely. Does that mean you have a lot of startups out of Georgetown University, or are you giving this as a service to others?
So, well, that's a good question. I'm sure Lita has the more startups than in 1 month than we'll have in a decade, quite honestly. No, that's a bit of exaggeration, but not much. But there's a couple of issues. So our strategy, I mean, if we're looking at GW, we don't have a lot of R&D, and so we're looking to the federal government labs in the area, because there's billions of dollars worth of federal lab technologies here. So our strategy is to commercialize their technologies. I've been doing this 1 year, and I think we probably have, out of that year, 2 or 3 startups that'll be coming out in the next few months. So that's to me, that's pretty good. But that, I think, a lot of this is an accident of geography. I think MIT is in that case. I think Stanford is in that case. I think we're in that case too. I mean, our 3 startups, which if they happen, it's going to be phenomenal. It's because we just have such talent in the federal labs here, and some of those are becoming entrepreneurial people, that they're just taking what they're doing in a classified environment with, in some cases, 200 employees, and just doing it on the non-classified side. That's hard to beat. But that kind of raises one question that really, I think, drives a lot of what we're talking about here. It's not the money, it's the entrepreneurs. So when you're talking about the bureaucracy and the bureaucratic mentality, that's the big problem everywhere. It's always the exception that you find the entrepreneurial person, because that person is probably somebody you would not like to spend time with.
Well, another thing that we found is, and it's kind of unfair. It's kind of unfair, but clusters feed themselves, because the management talent that's so scarce in most regions, where do you get the next CEO of a biotech company in Cambridge? It's the person who was number 3 in the last biotech company, so that but the other part of the human capital one is what I've found very interesting in the last, I would say 10 years at MIT, and that's the impact on the students. by seeing a succession of people who have started companies. They become exposed to role models. If you spend 4 years as an undergraduate at MIT, even if you don't take any entrepreneurship classes, you're going to meet 24 people who've started companies. So that changes people's aspirations. It means that they think, gee, you know, you don't have to be Superman or Bill Gates. Ordinary human beings are doing it too, and I'm going to do it one of these days. And I've seen that sort of cultural growth. Now, again, it's unfair where we are. I'm a grandmother, but my first job when I graduated from MIT was my professor's startup company. It's been going on that long. My husband's first job when he decided he no longer wanted to teach and get out of MIT after his PhD was his professor's startup company. In that case, it happened to be Bose Corp. But nonetheless, I mean, what I'm saying is it's been going on a long, long time. Maybe not, I mean, in those days, they didn't take licenses, so MIT didn't get anything out of these companies. But the cultural change takes a long time.
Yeah, I think that's absolutely right, because when you look at the people that do this, it is people that don't necessarily, it's not an intellectual thing. It's not that you explain it to them and they say, yeah, now I'll take the risk. They have to see it.
Yeah, they have
to live it.
Yeah.
Because it's exactly what Lita said. They look at this person and they go, this guy's worth $100 million or $1 billion. This guy isn't any smarter than I am, and so I can do it. And that's what you need. You need that. You need somebody to do it. Skype is a good example for Europe. They're growing. They've done very well, and I hear they're creating quite a spin-off, quite a family tree of other people trying to do things. But that's what you need, because you're not going to explain it to somebody and they'll go, yeah, I'll take the risk, because it's just not an intellectual thing. When you look at it, I said, well, you know, these are people you're not going to like being around. It's because they will be arrogant. They will likely be fringe people. People, when you start these things, it will be people that are not part of the community. It's people on the fringes of the community with the funny hair and crazy ideas. And that's what makes it very difficult to create these things in new areas. See, once it's proven at Stanford, you know, in Silicon Valley or MIT, then, you know, those people are just brought into the mainstream. So they're a little bit fringy, but they're not. You'll probably still not want to be around most of them if you're from anywhere else, but they're mainstreamed where they are. So if you're trying to do this, you have to find those risk takers. Those risk takers are the fringe people, the people that you're generally not going to feel comfortable around. That's the way to start it.
But the other thing you can do that is a little more purposeful is when you have some of these people in the community, make them heroes. Invite them to talk to students. You can push role models, and that's done. We do that quite a bit, so that, you know, when there's a mob of them, you no longer have to do it as much. But young people go after heroes, whether they be basketball players or movie stars, so bring them heroes that start to do that.
It's easy to do if you're in MIT, though.
Well, but there's always a few
you find
in
some.
every community.
You'll find. You need the mentors. You need the models. The other thing that you need to think about, because it isn't about money, and it's not going to be throwing money at it. It's also look at the culture. So what holds back a lot of people, even if they have this, you know, this risk-taking attitude, it's the friends, the mother, the father, the wife, the husband. Those are the people that, even if the one person has this risk-taking, you know, attitude, once he or she says, I'm going to do this, there's all this negative feedback from the community to say you're crazy. I mean, that happens a lot around here because, you know, there's a very, you know, healthy government employment scene here, and it's hard to find entrepreneurs because, you know, why leave a job that gives you $100,000, you know, pretty easily, right?
But you know, conversely, if you look at the U.S. of why there's been so much entrepreneurship, because in the U.S. now, if you're not employed by the government but by a large company, it's no longer lifetime secure employment. It used to be your choice was between the security of a large company and a crazy little startup. Well, now that the company does downsizing every 3 years, the relative risk of going off with a company is not as great. And I think that influences people too.
I just want to add one perspective or one thought. We're talking about the relevance of technology transfer agencies. That's fine, and I like this hero picture very much. What I want to add is, and that's not in contrast to what you are saying, that also the environment, let's say the city or the region can do a lot. Dortmund is a very nice example because we have started our technology transfer center in the middle of the 80s, and we have now there, depends on how you count, 8 or 10,000 people there. Many of these smaller companies are spin-offs. That's one point. We have still a lot of problems because we have no steel, no coal, no beer industry anymore.
I can't hear you.
We have no
Steel?
no beer, no coal industry.
No big companies. But beer went to Munich? Oh, that's sad.
So, but only one diamond. It was our university. And with the help of ThyssenKrupp, they formed a task force. I had the opportunity to help a bit with my knowledge. And they set up, we call it Dortmund project, and there you can find a number of things. You talked of this MIT model, so a lot about founder competition, etc. A lot of, let's say, not party atmosphere, but show people, help people, have a network around of lawyers, of people who do without any profit, who bring themselves in. And it's a long way, of course, but there are a number of these competitions, not only for high-tech people, but also for existing companies, growing competition. And these are all puzzles, and there I see it's very important to have a city who works in close conjunction or connectivity with the two universities we have.
And you talked about starting in the 1980s. Michael Ryan and I were talking just before lunch about in the U.S. where different states or cities have tried to create a cluster rather than, as happened in San Diego or Boston, they just happened. And, we can only think of one really successful example, and that took 30 years of sustained effort. And that's the Research Triangle in North Carolina. Part of the problem with the government initiatives I've seen in a lot of U.S. places and a lot of European countries, etc., is they expect something to happen in 5 years. The UK has a wonderful way of giving grants that are supposed to be self-sustaining in 4 years, and then they give another grant, but it can't be for the same thing. And it's like planting tomatoes and pulling them up every 3 weeks to see how they're doing. You don't get tomatoes that way.
More questions?
Tony, I just want to add something I already said earlier, but I emphasize spin-off is not the only mechanism to partner with small business. Just want to emphasize that there are places where established small businesses, high-tech small businesses are, in some sense, a faster path for the innovation process because they got accounting, they got marketing, they got manufacturing.
They might even have a competent CEO.
they got the business savviness already, so you don't have to teach a young entrepreneur or anyway, new entrepreneur all those skills. So I just want to emphasize that you need to look at both and not purely think of spin-off as the only mechanism. Then I think you're shortchanging yourself.
I fully agree, and there's one interesting observation, I hope it's interesting, that I would like to add, that the fact that in the process of sort of pushing entrepreneurship and making it more palatable to students, SMEs are becoming more attractive as an employer. So we have this tradition, or we used to have this tradition in Germany, that we were striving for lifelong employment. When I did my diploma in mechanical engineering at the University of Dortmund, all of my colleagues went to large companies, or almost all of them went to large companies. When you look today where they are, that's no longer the case. The pattern of lifelong employment that was present in Germany has been destroyed. That's gone. That's gone with globalization, and will go in other countries as well. At the same time, to the extent that we're now competing in much more dynamic environments where technologies are coming along, not every 10 but every 5 years maybe, and need to be explored, we also need people that are more dynamic and that are willing to switch employers and so forth. So we're approaching much more or to some extent a US employment pattern. I mean, we'll never reach the extreme. The typical youth in the United States, age 18, has 10 employers over the next 10 years. In Germany, it used to be 2. We're up to 4 now. Okay, so we're getting there. I don't think that 10 is the ideal, but the patterns are clearly converging, I think, despite of cultural differences.
Yeah, that's very interesting. I mean, one way you can import some of these models is what Michael is suggesting, which is these cross-border type of connections. I mean, the world is changing. So, I mean, the big takeaway is don't do things the way you're doing them, because and that goes for everybody in the U.S. as well as the rest of the world. The world is changing. So what you need are people that can ride that change wave. But how do you import it when you don't have it internally? I mean, when you don't have risk takers and people that want to kind of look over the horizon and look for change, you know, maybe what Michael is looking at, which is, you know, these cross-border connections. You want to say a few words about that?
I'm sorry, I don't think I got your point now exactly.
So
no, but it is. Yes, we have similar experiences both sides of the Atlantic. There's perhaps a time lag or whatever you mean to say. You are a little bit ahead, we are a little bit behind. Still, probably we do not want to make all your experiences that you have done so far. One regulatory aspect of that is also the exchange, not only on a conference but on a daily day-to-day basis, being in touch, and that is okay. Also from the for different patent agencies, we had contributions, but on the day-to-day life. I mean, not every day, but during the whole year and curricula, to have people work together in this process of going from idea to innovation, and what you do with the innovation. And I mean, in this process, you do that not only at the universities and with academics, you have companies, private equity in the boat all the time. Mm-hmm. And also here, as I said in my talk, both sides of the Atlantic, yes, you are a little bit limited on the type of companies you can deal with, but the transnational companies, and that does not mean you never work together with headquarters. You have on both sides branch offices or even individual laboratories. But they are, it's a matter of trust that you have to work, for example, with HP in Germany and your partner in the US at the same time with HP in the US. But again, you are not working with headquarters, but you have in this 2-point support, you can move ahead and advance this mutual trust and progress.
Now, do you place students overseas, like at HP, or is this an HP relationship that you're having, in Germany?
No, usually it's not students that are at the companies, but in this one example, there's a very good It's more than an exchange. No, it's not a student exchange. It's an idea exchange and innovation exchange between the university and NIST at Gaithersburg. From there, the companies are then one step further. And yes, we have students that are taking the diploma in Wiesbaden and then a PhD here in the United States, being stationed, if you want, at NIST. And at the same time working also then in extension to their diploma work in Germany, not all the time, but for example at HP also here in the United States.
Yeah. Because that might work. I could see that working. And when I say students, I don't mean students for the educational piece. It's more for the mentoring piece. And maybe it's grad students, and maybe it's recent grads. If you place them in some of these companies in the United States, in a few years they'll come back and they'll see the world differently, because they will be exposed to that risk-taking and see that these people are really not giants. You know, I mean, they're normal people. They're just risk takers in an environment that rewards risk. And we're in because it's a change. It's a sea change. It's a new world in a lot of ways. People that take that risk, some are going to do very well just because you're a risk taker. And so it really is just facilitating that, I think, because it isn't anything that's innate. Now, the issue, though, I think you're going to have is that students, young people, are the people that look for change, right? Older people, older people, people that are established, don't want things to change, right? Because they have a place in the world. But when you're young and you're coming out of school, especially out of school, that transition period from going from school to the world, there's no place for you yet. You have to elbow your way in. It's a lot easier to elbow your way in a startup or some of these entrepreneurial environments. So that's probably the way to change your culture faster. Your culture is going to be changed. I mean, this is a huge, long cycle. It might take 100 years for the world to really get, where it's going to go. It could be as drastic as going from the agricultural age, the agrarian age, to an industrial age. And that took hundreds of years before a lot of people left the farms to work in cities. Well, we're probably looking at that kind of migration again. I don't know where they're going to end up, but they're not going to be working at large factories, which was the traditional model for the last 100 years, let's say. They're going to be somewhere else. And the people that get there faster and sooner are the ones that are going to be leading and taking advantage of that.
Tony, can I comment on the students, back on the students?
Sure.
One of the things we have done is to bring students to the small businesses, what we call the small business grantees. It's enormously popular. These are focused on undergraduates, and basically we fund them equivalent to like a summer, couple of months in summer. Then we expanded that to what this morning you heard, like K through 12 teachers, but mostly high school teachers. And now the idea is if you can bring high school teachers into technologically based small businesses, they are going to be even stronger in touching the future students and our future workforce. Both of them have become quite popular with the small business. Of course, the small business is looking for some of these students, maybe future employment. They are evaluating their capability, and if they are good, they may even offer them a job when they graduate.
Yeah, I mean, there was a recent study, I think it's on the National Venture Capital Association website, that talks about how many foreign people, I think a lot of them came as students, ended up creating a lot of the companies you know about that are seen as American companies. A lot of them were created by Indians on the West Coast and by, I think Chinese, but I think Indian was the largest represented nationality. Hotmail, I mean, really huge companies. Hotmail, Intel has somebody, I think, who was originally a grad student from India and then ended up staying. I mean, so that's a good story, especially good for the U.S. Some of them are going back, and that's not a bad story for the world either, right? Because now, a lot of the innovation that's happening in India are people that came here, learned about it, not from places that don't have entrepreneurship, but Silicon Valley, for example, or Boston, MIT, went back with their connections, with their new frame of reference, with their new understanding about risk-taking, and made things happen there. So you might look at that as a model, because I don't think Germany is doing it as much as other countries. Because it always helps to be, so low sometimes that you got no place to go but up. And I think that might have been what happened with some countries.
Let me shift the emphasis a little bit, because I think it's not quite true. If you look at the leadership in Chinese businesses who are driving much of the change in China right now, a lot of them got a doctorate in Germany. So there is this kind of openness. The problem that we have in Germany is that we force them to go back directly after they got their degree.
Yeah.
Right? So we would like to have the nice effect that they first build a company in Germany, at least most of the people here would like to have that effect, okay, as they do in Silicon Valley, and then go back to their home countries as successful venture capitalists to build new firms there. But we would like to have a few jobs in the process.
Not only jobs. I mean, they will give you a new perspective.
I agree, but you have to realize, of course, the United States, and that came out in the talks this morning, is a classical immigration country. Immigration has been the model by which the mold by which this country has been built, and that's not quite true. It's true for the United Kingdom as a former colonial power with lots of countries that were associated with the British Empire, but not so much for France and for Germany, the continental European countries. But we see more and more that our university programs are very attractive for people from industrializing countries. But some of our legislators haven't quite figured out that it might be meaningful to leave these people in the country when they have finished their degree, which we should put on TV and send them.
Figure out, or in general, the politicians didn't figure out, also some universities didn't figure out that we will compete more and more for the brightest. That's, at the moment, not so true about engineers, but very true about the entrepreneurs. I spent a little bit of time, I studied there only shortly in Berkeley, and I met some Germans who deliberately, or they really planned to come to the West Coast and study in Berkeley to become young entrepreneurs with startups, because they knew that the environment for building a startup, funding or starting a company is so much more difficult in Germany that it makes sense to study in US, to go to Berkeley and to the West Coast, because they knew it would be much easier to start there. And I think that's the future. We will compete for the brightest. Mm-hmm. In Germany, we attract some of the brightest, but we send them back. You said that very correctly. We give them the education with German funding, taxpayers fund it, then we send them back. That's so incredibly crazy. And you see, you also have to know about the demographic development in Germany. We would need every engineer, every entrepreneur. We should really try to keep them, but that's okay.
Well, I have to the folks from the United States. Let me tell you, your problem is coming with a time shift of about 15 to 20 years, but it's coming to the United States as well. I mean, what?
They are doing the same visa problem we were talking about.
Yeah.
So they are following us.
Oh, so you mean we're the leaders in that
well,
business?
we have a particular problem called Homeland Security.
But I thought it's a great impulse for new technology.
Yeah.
Okay, I think we're at 3:30. So if there aren't any more questions, I think we're ready for a break.
I always do. I'll give you my little poem that I do.
May I have that?
Yes.
Thank you.
He was told that he needed a sharp business plan and a rate of return that was high. But where was the profit in peace in the land? Access would get a piece. I didn't know that you have this.
This is what I do when I get bored.
Thanks for participating. I think it went really well. Thank you. That's really interesting. You have some interesting stories.
But you're not leaving yet.
No, we had an award ceremony last month at the Bavarian economics minister camp because we chased 450 bachelor students in the third semester through a business planning exercise where they were given, or teams of 4 students were working for an entrepreneur who came out of unemployment and was entering entrepreneurship. And each entrepreneur got 2 teams of 4 students so that they were in rivalry.
Did he give them the idea of what he wanted to do?
He shared the idea with them, okay, and they advised him, did the marketing research.
Terrific.
It was wonderful.
Wonderful idea to have them compete on the same ideas. What
mean,
a beautiful thing. Great. Yes, sir.
I'm supposed to be saying hello to your father, Alex.
Where is Alex?
Well, he's right now.
You must be England.
Continental Europe.
Oh. So Alex is in Cambridge.
Yeah, in Cambridge. Ja,
Continental Europe. Damit meine ich in dem Fall Europas ja auch ein Kontinent ist.
Aber ich
Sag nicht Europe behind fog oder so.
Check 1 2. Check 1 2. Check 1. Check 1. Check 1.
Some of the German gentlemen were telling me, it's just a shame that none of their government representatives are here. They're really some of the ones who really need to hear.
Were some of the
I know, it's really sad, isn't it? Thomas, do you have your watch?
Yeah, I put it in the.
Have you seen this? His smart tab is on his watch.
I'm not finding it. Really?
It's so cool. And then he has a.
Where is it?
Where's your pen?
Check 1 2.
Check, check, check.
I first have to.
Oh, put it on. Oh.
Check 1 2.
You want to go. To
Check 1 2. Check 1 2.
And it should be. Probably the first one, maybe?
Check 1 2. Check 1 2.
And so.
Check.
If you minimize the screen a little bit or shrink it, that middle button, and then just click on it and pull it out.
It's still there. Okay, fine. Das? Ja, genau. Was denn gut mit dem Mann?
Check, check 1 2 1 2. Check 1 2. Check 1 2.
This one, yeah?
Go and you can open it if you'd like.
No, I want to take it out.
Oh, start USB master. You're very good. I never obey that command. I forget.
That's not good. Yeah,
I know, and they say you're going to kill your computer. I said, okay.
Yeah, and I lost memory sticks by this.
Check, check.
Kidding.
Yeah.
Check, 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 check. Check, check, check.
Australia?
Right. This is
By way of introduction, by the way. Look at his cool gadget.
That's just a simple watch.
I think IBM